if we get some weaker data and yields continue to slip, I guess some people will still be wanting to buy a few metals. That's how I look at it. Market is going into the NFPs with a weak dollar feeling, right?
Yeah.
Currencies are on decent levels there, so gotta be a bit pay a bit attention, because there's nothing worse than a market that is forced to buy dollars if we would get a real decent beat. It's not my base case
Yeah.
because I also look at a little weaker dollar perhaps, but it would be something if the market is really forced to buy dollars. Imagine that the 10 years going back above that 35.40 zone due to that report. I guess that's going to have people think twice on a Friday afternoon. But let's
Yeah.
see that number first. If we confirm, because I read a lot of people thinking that May is really the month where we are going to see those weak numbers come in. I know what people think. The in an election year they are never going to produce bad numbers, but the numbers are the numbers. Imagine that we get a bit of a weak one, then I think stuff like well, euro is probably going to shoot through as well. But I think things like the cable, Kiwi, those are two currencies that I pay very close attention to for shooting through decent levels. The Aussie is a little less buoyant than the Kiwi of late, right? So that one is not going to be my preferred, I must say.
Is the yen still a no trade for you?
Um, no, I think today it could be one, especially on if it's real crap data, then the market is going to start thinking about that Bank of Japan reducing the bond program over next week's meeting. So that may have a pretty decent impact on the dollar yen. But in turn, if we get a real good one, which is going to support the yields, and a very good job market should also support stock markets after the algo blip lower, perhaps on the back of higher yields. I think then the yen may suffer a little bit in turn, and we could be back at 157 in a flash as well on the dollar yen.
Okay.
I think today is
Everyone
a,
got, go ahead.
sorry, I think today could be a very volatile day, especially I'd say especially if the market starts to stick their teeth in a real slowing jobs market. Yeah.
Okay. Well, I think Shy Girl's only looking for 1,000 new jobs, right? In the contest,
I saw that
right?
too.
Huh?
I saw that too. Hey, Dale, do you mind if I take over
No,
for a few here?
go ahead, buddy.
First of all, yeah, we are broadcasting on YouTube. For those of you that were wondering, we're not sure what happened earlier. So, but K-Man, I agree with you. When you're trading and you're like, I put my money on the wrong horse. I'm sitting here long. I've been long Aussies pretty much all week, and I'm up very slightly. But waiting for this major trend line to break. But you're right, Kiwi looks so much better. And matter of fact, I want to point out that Kiwi is above this multi-year trend line right now. It already is. Now we've got horizontal resistance coming in at
Yeah,
62.20. That's a big one, right? I
yeah,
mean,
I think I'd rather have that, because that's the issue with trend lines, right? When the market comes to trend lines, your trend lines are starting to show a picture, because your trend line continues to go down. So it may look as a break, but your market hasn't really moved. I mean, Kiwi's been hanging here for the past two sessions, right? So it's just
yeah,
waiting for I think just the nod, you can go now, and
right.
I'll
Yeah.
make a report. That's what I
Yeah.
think.
And it's not just the Kiwi. And this is the thing I wanted to point out with the dollar. I mean, Dale, you've been pretty bearish the dollar recently, rightfully so, and it's really gone that direction. And I want to just point out, like, if you look at the dollar index, we can't get above this whole week. We've
Yeah.
been situated below the 200 DMA. That's the red moving average you see here. We've been sitting below it. We've been sitting below that channel support. And we are like literally, you can here, let's make this a different color just to make it a little bit easier for everybody to see here. If that support goes, I mean, there's got to be stops sitting below the market now. And it's not just the dollar. Well, it's the dollar index, but take a look at all of the currencies that are set up. You got the euro that's, you know, pushing right up against 109, sterling right against that triangle resistance, and you know, you got the Aussie, the Kiwi, as we pointed out, the Canadian, which Dale, you called the false breakout the other day, but you know, if the dollar CAD, well, we got Canadian and U.S. jobs, right? So that could be a little bit of a as you know, K-Man likes to say in the chat room, saloon doors might be swinging there, but you know, and then you got the dollar yen, which is holding up really well by the 50 DMA and channel support. But if that goes, you know, following a poor report, we could really see the dollar moving against so many different currencies. So I don't know. I love the setup, but I want to ask you guys this, and let's start off with Ryan. How are you going to trade a good or a bad number? Like what are you going to be thinking in either situation? You get some good data. How are you going to approach the market if you get some nice strong data, and are you going to be long the dollar, or what are you going to do? And if we have really bad data, what's going to be your trade of choice?
I'm setting my stall out to fade a good number, so I'll be selling any dollar rallies, and I'm going to pick Kiwi as my pair of choice.
Okay.
Because as you guys just been saying, it looks like one of the strongest. But they're all looking like they want to bust out. You know, euro dollars tapping on the 109 cables, trading 128. You know, Aussies getting up there, Kiwis on trading against the 6200 level. So they're all itching to bust out. So if it's good numbers, I don't think they're going to last. So I'm going to try and buy a dip in the Kiwi.
And I want to just say that if we start to see, like, let's say, I'm just you know, obviously hypothetically, let's say the euro's trading at, you know, after the number, euro's trading at 109.20, sterling's trading at 128.40, you know, kiwis at 62.40 or 50. And you got to think about, like, here we are, you know, let's just imagine we're an hour or two, you know, past the data. The market's already reacted. Fridays a lot of times are trend days. I mean, and when you have the dollar breaking down against everything, it's going to be a hard fade. I know what, like, you know, traders like us, a lot of us want to do is, our natural reaction is, oh, I'm going to fade strength, I'm going to fade weakness. Today might be one of those days that you don't do that on a Friday afternoon, you know, because everybody's going to be coming in, you know, or trying to leave for the day, and you start to see a move that transpires. I don't know if I'd want to stand in front of that. Just
you're right, but also on the other side, I wouldn't chase it if you're not, you know, if you don't get the break of 109, you know, I wouldn't be chasing it at 109 30 40 because then you might run into, you know, the dead hours and profit taking and all the rest of it. So
that makes sense. So go ahead.
If you want to go the other side, let it break, wait for a retest of all these broken levels, and if they hold, that's your key to have a go.
All right. Great suggestion, Ryan. K-Man, what are you going to do in either situation? What's your, like, trades of choice here?
Well, real bad ones, I think yields are going to come off, and dollars should really get a slap around the ears. So choose your pair, really. But I think my pairs of choice are the cable and the Kiwi. But watch out with stocks, I'd say, if it's real crap, okay, like a real negative number. Yeah, dollar yen will probably collapse, and but stock markets may not like, you know, stuff like Dow, whatever. If you get an algo blip higher because the yields are lower and people buy equities on a real crap number, I don't think that's going to last this time. So that is not going to be one of my instrument of choice. I'm still a tiny bit long S&P, but if I get a real crap number, I'll sell it out. If I get a mild miss, I think S&P is going to push through, really through, as well as on a real good number, because then, as we've been talking so often about, very good jobs data are not supportive for lower equity markets, okay? I think we see a blip lower on the higher yields and then reverse to the other side. So that's opposite to a real crap number.
Yeah, and I was just can I just add here, K-Man? You know, the markets have been really responsive to, you know, good number, you know, no recession, yada yada yada, soft landings, everything else. And and we haven't seen a bad number on NFP in quite some time, actually. You know, I have to go back and look. So but continue on.
Yeah, but that's always the risk, right? That all of a sudden you do get that that bad number. But okay, I mean the whisper number is 165K. That would still be well within the acceptable range. Then we need to look at the usual, the components. But I'd also look at the repetition between government and private payrolls, because we may see a discrepancy in there. Like, imagine if it's almost all government jobs, it may not be liked so much. You know, it's a bit of an interesting read today.
Even on a miss like last month, remember last month the number came in, you know, 50-60,000 below expectations.
Yeah.
The market still bounced back because it's like, okay, we're at least creating 100,000 jobs. I think 100,000 or 120,000 jobs, that's where most people are comfortable. Like we are productivity wise, we are creating enough jobs. But you start dipping below that, the 100K level, and that's when things get scary. Yeah.
Drop below 100, that's not going to be liked, I think.
There you go.
And then you have the double whammy possible, the saloon doors on the Canadian, especially after the Bank of Canada, which cut their rates. If you get, like, for instance, a bad NFP in the US, but a revival in the Canada, your 136 will probably be toast on the dollar Canada, right? If you in turn get a good jobs report in the US, but Canada confirms the slowdown, then you're probably looking at 138 in the dollar CAD. So I think the CAD is going to be on the move today as well.
Yeah, and I really, really want to buy the dollar CAD, but as I told everybody yesterday on the Morning Edge and the Daily Roundup, those are the private ForexAnalytix shows. I'm so bearish the dollar overall that what I would use is any sell-off in the dollar CAD to really buy it longer term. But you have to imagine there's a lot of stops below this 136 level, don't you think, Dale? I mean, look at what a big pivot it is. Imagine all the stops that are sitting below here if we start breaking down. I don't know. It looks vulnerable to me, and that false breakout's definitely not helping it. You know, following the Bank of Canada. I don't want to look ahead into next week, but we do have too far. But we do have the BOJ. We have CPI, which we always cover live here. We have the Fed. Lots happening this next week. So Dale, how are you going to trade the non-farm payroll today? Dale might have left the building for a moment. Not sure. Dale? I don't hear him. All right. So let me, I guess I'll talk then. So as far as the NFP goes, and if we have a miss, I think sterling is so well bid. It's pushed right up against resistance. And it looks super strong. And I'm with Ryan and K-Man on the Kiwi too. It's we're nudged right up against that resistance on a strong number. And Ryan, this is where I'm gonna have a little bit of an issue. I really don't have much of a plan on strong data. I mean, if we have strong data and let's say, you know, the euro backs away to 106, or excuse me, 108.50. I don't know if I really want to be a buyer down there. Like, you know,
for what reason?
Because if the data is strong, like let's say we come in at another 200,000 jobs, unemployment's at 3.9%. You know, wage prices are you know, the wage numbers fairly hot. I don't know if I really want to buy the dollar. I don't know if I want to fade it. Let's put it that way. Like if the euro dropped back down to 108.50, I don't know if I'd be sitting there trying to fade it, going, okay, well, that was really good data, but you know, so what? I just don't know if I can do that. You would really want to do that on strong data?
If evidence suggests over the last few weeks, data points, prior NFPs, that the market is looking for when the Fed wants to cut, and anything that doesn't go that way, then we see a dollar rally, but that soon gets faded. It's been faded time and time and time. You only got to look at the chart there since we got up to 109. Every dip has been bought up.
Yeah.
Every dip has been bought up. And the price action suggests that that's what the market wants to do. So, you know, what they're not going to hike. If we get 300,000 NFP, unemployment 3.8%, wages 4.1%, no one's going to expect them to hike. So we'll get a reaction, but then the market's going to go, well, they're still cutting because they've told us blatantly they don't want to hike. So unless they turn around and say they want to hike, the market's going to keep pushing for cuts.
Yeah, I guess that's definitely a way to look at it. All right, you might have me convinced, but what we're going to see here in a few minutes, I don't know though. So I'm going to put the dollar index off to the left. We have yields right in the middle. We have the S&P to the right. Dale, are you back in front of your desk?
I am, bro.
Okay, we missed you a little bit. I was going to ask you, and I'm not going to be able to go into the charts now, but how do you want to play dollar strength, dollar weakness? How are you going to do it?
Okay, well, I'm going to try and stick with Canada. And if we have dollar strength, like I agree with you, if they're going to take it under 109 to 108.50, I'll wait for 107.50.
Okay, all right, 107.50. Okay, all right, and you'd be
I'm not selling it. I have a rule now. I'm not playing counter trend. I believe the trend is down in the dollar, eventually a breakdown. So maybe I'll miss a move. I wouldn't rule out a pop in the next week or so to 105.5. Could still happen. So, and some of the shorts, if we got down to 103.5 to 102.5, I'll take some more off down there.
all right.
So nothing new really.
Got it. All right.
I've made my bed.
So we got about a minute. K-Man, Ryan, any last minute thoughts before this data comes out? Oh, you guys have like less than a minute to take your guesses. I have to imagine Michael Brown's like, waiting to the very end. So did he put in his guess yet, Ryan?
Yeah, he put in 160 and I waited and then I went 159.
All right, 45 seconds, guys. Any last minute thoughts? Ryan, K-Man?
Nope. No, not really. I said it all.
All right. We've said it all. So everybody prepared, be prepared, no more bets, and get ready for some action here. Again, we have the data flash right here so you can see the data as it's being released. I'm going to try to, get us down to see the Canadian data too as it's coming out. But there's a lot of it coming. So let's see if I can pull that up a little bit further. There we go. All right, guys, stand by. Here we go. 5 seconds left. Drum roll, please.
Hot.
Oh, hot.
Wow, hot.
Yeah.
Jeez, Louise.
See, that's why. I've been worried about that all week. Haven't I?
I mean, that is hot. Holy hotness. Well, damn it. I was really hoping now I'm like, what do you do? I mean, do you buy the euro here? I mean, that's the thing. It's like, I don't know.
Look at the metals are pressing.
Unemployment went higher, okay, and that's even with the participation rate coming down, so that's a bit negative. But wages jumped to 4.1%, so there's the inflationary pressure. So overall, that's hot number. We should get we could see a bit of US dollar buying here.
So here we come, 105.50 in the Dixie coming.
Yeah, I don't, but see, I mean, the euro, push below 50 and 108.50. I mean, we're trading a little lower right now. And look at that dollar yen. My goodness. Wow.
That should set up a nice short.
Yeah. And look at the CAD. I'm sorry, I didn't even look at Canadian data. What we got on Canada?
No, average, it's roughly as expected, but the full-time, part-time job repetition is not great. Destruction of full-time, but bigger pickup in the part-time. Unemployment rate ticks up 0.1%. I mean, pretty average report, I'd say. nothing really. But the hourly wages are went up again, so I'm not something you really can trade too much on the back of it, I think.
You know, the
Yeah.
S&Ps are acting pretty respectable, considering.
Sorry, I'm just doing a little bit of bee's nest here. I'm actually going to pick up some sterling down here. So I picked up a little bit of sterling. So we will I'm with you as far as buying the dip goes. I think we're about 50% back of this move. So I want to pick up just a little bit, and I'll look to add actually closer to this green line if we can get down here. But man, that is a hot number. That was not expected today. And how many, I mean, I got to ask you this, Ryan, right off the top of your head, how many people guessed it was going to be a hot number above 200,000? I'm assuming not very many in the guesses that you got.
I haven't looked yet because there's hundreds.
Yeah, I know there's a lot of people that have guessed, but I have to imagine there's not too many. So if you guessed anything above 250,000, I think you're in the running for winning the multiple prizes that we have going on. But yeah, I just picked up a little bit of sterling down here at 45. Actually, is where I got long. What Dale, did your interview from yesterday coming in today?
Yeah, Michael's here.
Michael's here. All right. Well, I'm gonna pass it over to you guys. It's gonna be interesting. Gonna see how the market responds to this data. But man, it is strong, and the stock market didn't like it. That's the one thing that we have to, take into account. The stock market didn't like it initially, but it's hard to fade stocks on good data like this. On good data, I would assume the stock market will recover by the end of the session. The S&P will be back, probably, near its levels that it was overnight. So anyway, Ryan came in. Thank you guys for being here with us every single day. For those of you guys that have, are always here supporting us every week, really appreciate you. And Dale, thanks for guiding us every single day. And I want to wish everybody a great weekend and have a great interview with Michael.
Thank you, Blake. Thank you, Ryan. Came in.
Cheers, guys.
Great team. Have a great weekend, you guys. Nice week of sharing some nice insights for people. And this is what had me a little bit freaked all week. I thought this could happen. The dollar short felt too obvious. Anyway, here we go. Michael Kramer, welcome back. It's good to be able to talk to you on an NFP day. How are you, Mike?
I'm good. Can you hear me okay?
Yeah, loud and clear. And if you want to share your screen, that's ready to go as well. So market was surprised today.
Yeah, I'm trying to turn on my camera, but it's not turning on, so I hope that's okay.
Yeah,
you guys know what I look like, right?
Yeah, I do. I remember. All right, so here you go. You want to start with this employment table?
Yeah, I was just, the first thing when I look at these job reports, the first thing I always look at is this household survey to see, sort of what's going on here, because there's a lot of, if everyone looks at the non-farm payrolls, and that's obviously a big number, I think if they're going to try to take away anything out of this to make this a reason to cut rates, right, which is what the media has been trying to do really hard the last couple of weeks, they're going to say, oh, the unemployment rate went up to 4%. But, I mean, when you look at the number, I mean, it's 150,000 people got added to the unemployed column, which isn't a lot. The employed sector was down by 408,000, which is a pretty decent size. And so but the actual, what's odd, I guess, is that the actual labor force shrunk in the month. So when you look at the actual population, it declined. So I don't know if there were people just retiring, because you can see that the people not in the labor force increased by a really large amount. So it almost looks like people were just leaving the labor force and going into this side of the world. And maybe it's because they can't find employment. We're not really going to know, but it's really when I look at the wage gains, it's a really impressive number. at 4.1%. First of all, this was kind of hinted at when you read the NFIB put out a survey yesterday. They always put out their employment survey the day before. And when you combine that with the S&P Global survey, which is the other one that comes out that doesn't get any of the headlines, because the ISM always overrides it. That one also was talking about high services and wage pressures, hurting input costs. And so I'm not really surprised. I'm just surprised that the wage number came in as high as it did. I mean, that to me is really surprising. And then last month was revised higher. So, when you think about what this means, I mean, you basically, if you listen to the Fed talk, they're always talking about what's the rate you need to get on wages to get a number consistent with 2% inflation. They usually say, you want 3% wage growth. You figure 1% productivity gives you your 2% inflation rate. Well, right now we know we have a 4.1% wage growth number in May. We know that the first quarter there was no productivity, right? Because that number came in yesterday at 0.2%. And it's basically telling you have almost a 3.9% inflation rate. And that sort of goes with what we've been seeing in the CPI reports around this 3.5% number and something closer to 4% on core. And this is just sticking with the story that I think inflation is a problem, and the Fed's not really getting the amount of cooling in the economy that it really needs to bring rates down, to bring the inflation rate down to where it is. And like I was really confused all week because you go on Twitter, which is really I don't know. I go on there lately and I'm just like, you feel like you enter an alternate universe because all week, over the last couple of weeks, we've been looking at really strong data, and all of a sudden, like everyone's turning so negative, and it's like, oh, we're, the 10 years falling. I mean, oil prices, a lot of the move down in oil 10 years has been because of oil, but that was because I think people were surprised by the OPEC quota changes. And, oil's been kind of coming back the last couple of days, and so is gasoline. So I don't really know that there's really much there. And I really just don't see a lot to suggest that the economy is like melting or that obviously the job market is really melting either. So,
so what, do you think they're going to take away all the gains in TLT from the 88, 89 level, rallied to above 92, rallied to 93?
Yeah, I mean,
to me, it looked like we were breaking out.
Yeah, I mean, they already took away. They were pricing in 2 rate cuts as of yesterday, and now they're back down. They took the one away from November, and and then you get a CPI report next week. But yeah, I mean, when you look at where the TLT has been, it looked like it was going to break out, where it was breaking out, right? But then when you look at where the 30-year is right now, the 30-year's up 9. And when you look at it from this perspective, I mean, we could easily move back. We kind of held support right at this 440 level. I have multiple charts on the same thing. So
okay.
It's certainly possible we could be right back, into this range above 460 again. There certainly doesn't really seem to be a reason that we should see rates moving significantly lower from here. And it's the same thing really with the dollar. It's been weaker, but when you look at where it's been, I mean, it's holding these key levels of support, I think, rather impressively. And the things that I've been watching the most are the Canadian dollar, which is something we've talked about here in the past. And I've been watching the Mexican peso a lot because of its status sort of as a risk gauge. And they actually just reported CPI this morning that came in a little bit lighter. So then when you couple that with what you got in this job number, and you're looking at, a peso that can probably continue to rise above 18.
Yeah. And you think that's more interest rate related than politically?
Well, the first move obviously was the election, right?
Yeah.
With her getting what looks to be a supermajority, from what I understand. And I'm not an expert on Mexican politics, but this move here seems to be more obviously, economically data sensitive.
Right. Okay. You know, we've made new all-time highs. Maybe you could explain this to me. We've made new all-time highs in NASDAQ, S&Ps before today, and the Dow's 1,000 points under its double top. What's
Right.
the issue with the Dow?
Doesn't have NVIDIA.
Okay, that's the
I mean, that's the
yeah.
biggest. I mean, NVIDIA, I was on Fox Business earlier this week with Charles Payne, and we were talking about how, and I wrote about this yesterday in a Seeking Alpha piece, and we were talking about how NVIDIA accounts for 40% of the gains in the accounts for 30% of the gains in the S&P and 42-ish% of the gains in the NASDAQ 100. And that's the primary difference, right? If you take away, I think, Meta and you take away NVIDIA, you have nearly, you know, we can actually run the numbers right now. You're going to see that like 60% of the gains vanish.
I think there's also, I was talking to a buddy of mine, a trader friend, Jim Walsh, and he was talking about the number of stocks beneath a moving average. It's higher than it was in 2021, like 26% or something like that in NASDAQ.
Above?
But beneath
Oh, beneath.
moving it, yeah. So
That
it's
doesn't
like
sound like a
it's
very low. That doesn't sound like a bad number, though. Am I thinking about it the wrong way?
That a quarter of NASDAQ stocks are underneath their moving
Two.
averages, which is saying that a lot of these markets are 26% are down on the year. So that's
Right, but
it's not
doesn't
a
that
good
mean that
number,
75% are above?
I guess. Yeah. So
That sounds
maybe
like
I'm.
a pretty good number.
Oh, okay. All right. Friday.
Oh,
What do you
I
think?
don't know. I think that's, I mean, I'm doing off the top of my head, but this is the gains for the year, right? I mean, the Nasdaq's up 13%. You have 61 stocks up, 43 stocks down. NVIDIA accounts for 42% of the move. Meta accounts for another 11. So that puts you at 52. Microsoft, you got 9. That gives you 61. Broadcom gives you another 8. That's 69. Amazon gives you another 8. You're at 70% almost. And then you take Google, which is another 10%. If you're double, you know, you're at a tremendous amount of right here, right? And then you see that the Nasdaq's up 13% on the year. And if you actually look, how many stocks are up more than the Nasdaq this year? Just 33, 32. Everything else is underperforming the Nasdaq. So you wouldn't have an index up 13% if you didn't have
Concentrated gains.
Yeah, I mean, you know, even Microsoft is only performing at the market. You know, you have I can't believe Meta's up 40% this year, considering it's not even at the high.
Yeah.
Right? Remember, it got crushed.
Right. Yeah.
That was that 10% decline.
What's your view on Amazon up here?
Oh, I mean, I own Amazon. I actually bought it a long time. I bought it October of 22, so somewhere in here.
Yeah.
I mean, you can see it's not real. It's kind of struggling at these highs.
Yeah.
I mean, I like it. It's not something that I would sell at this point. I mean, it doesn't mean that it's probably a little bit stretched like everything else. I mean, when you look at it from a technical standpoint, I haven't looked at it from a technical standpoint in a while, but this is clearly a resistance area. You know, you clearly have, you know, a trend line here. You clearly have potentially a breakout here, but you know, if you look at the momentum, it's pretty weak. So, I mean, looks like the 190 region is sort of the upper end of the range right now.
Yeah, I may try shorts at new highs for a 3 drive to a top formation.
Yeah, I mean, clearly, like if it breaks this 180 area, you know, you got a big gap to fill down here at 160.
Yeah. Yeah. So, any view on, you have your view on the dollar. So you think that the dollar bulls could be right here, and here we are.
Yeah, I mean, I don't really see. I've been bullish on the dollar for a really long time, and it's been really, it felt good, during this period of time, but it's been really frustrating since about here. Um, I'm sorry, it felt good during this period of time. I'm
Yeah,
looking at the wrong chart. And then
yeah.
obviously it's been frustrating to watch the dollar sort of weaken since mid-May. And I've been expecting a turn in here, and that really hasn't happened yet. And so, I mean, if we can actually sustainably break this trend line here,
Yeah.
I don't really, I mean, again, when you think about where policy is in the world, you're talking about probably maybe zero, maybe one rate cut this year out of the US. It's looking like the ECB cut, but maybe they shouldn't have cut. I think their wage data today came in at 5% or something. Um, and so when you look at the widening of credit spreads, really across the universe, this is the USD CAD. This is the USD minus the German 10-year. I would tend to think that these spreads should continue to widen. And if these spreads continue to widen, then that should be dollar bullish, right? And I that's what I sort of have been thinking. And to this point, I mean, it was right for a while, and that's kind of stalled out. And it's a little frustrating because the data has actually been pretty solid. And, the Fed has been pretty consistent in their messaging. And so my view is that you should still continue to see these spreads widen. I have another chart that.
So is that the same danger signal as credit spreads widening? Because I did notice, the last couple of years, the best technical structure in the bond market was HYG, the junk, and the
Yeah,
worst was treasuries with LQD in the middle.
right.
And on this last bond rally, the treasuries have way outperformed HYG, and I hadn't seen that in a while. Is that
Yeah, because the credit
staying
spreads
in?
they're beginning to widen again. I use the
Okay.
CDX high yield credit spread index. You can use TradingView has something called TradingView has the 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 AAA credit spread index, and it has
So this could be a warning sign for
so this is the option
equities.
yeah, so this is your option adjusted credit corporate index option adjusted spread, which is your credit spread, right? You can see
Right.
it broke the trend line. Now, if you look at the high yield one, this is the if I can find it, this is that one. Oh, here's your high yield one. This has been starting to turn higher too. But more
Yeah.
importantly, when you look at this CDX high yield credit spread index, and then you just take the Russell, let's say, and you go back for 5 years, because people are like, oh, 10-year rates are coming down. Why isn't the Russell going up? It's like it has
Because
nothing
of KRE. Because of
well,
KRE.
it has nothing really to do with the actual treasury rate. It has to do with
So you're not in the Tom Lee camp of looking for the Russell to double. Maybe that was he made that call.
he
A
did.
lot of the Super Bowls had been waiting for, which had started to catch up at the beginning of the year, but that has changed again. It's
Yeah, because credit
definitely
spreads are.
okay, because
I'm
credits.
trying to. So you got the Russell in blue and the CDX high yield credit spread index in white, and you
Yeah,
see what happens.
yeah.
So the
No, this.
Russell is just following credit spreads, and you can do the same thing really with the S&P 500, to more or less. You can take you see the S&P in orange. It's the
Yeah,
same, except they're separating here.
they are. Yeah.
So that's the thing. Like, I just sit here. I don't even care what the equity market's doing half the time anymore, because first of all, I don't trade it on a daily basis, right? And number two, I know that it's heavily influenced by NVIDIA. And so that has, and I have a feeling once the stock splits, that whole story may change, right? It's not easy to keep adding $1 trillion to market cap every 30 days, which is what's happened. I think the market cap went up 600 billion in just 10 days. And it went up over $1 trillion in 33 since the middle of April. I mean, these are just ridiculous things, and people talk about it not being a bubble, but I don't know what else it could be. You know, these are not normal movements. And when you look at what credit spreads are doing, they're too low. I mean, there's the market right now, at least in credit spreads, are priced like when the Fed was doing $120 billion a month in QE, and financial conditions, were easy as ever, and you had 0% interest rates. There's a lot more risk out there today than there was then, right?
Yeah.
And so it makes no sense to me to see that. And if you get a move down in the credit spreads, if I normalize this again, and you look at, the high yield credit spread index going back to something like 400, that's going to equate to like the S&P going down or into this 400 to 460 area, equates to like the S&P 500 going down to like 4,500.
Okay.
So I know that like that's been the wrong call from an equity market standpoint, and I think like it comes down to your viewpoint in time. I try to take a much longer viewpoint than the average person does these days. I think the average person probably has a viewpoint of about a day, it feels like.
Well, look at all the volume in 1 day till expiration options.
Right. And so, when I'm writing and when I'm talking and I'm presenting, I'm not presenting with a 1 week outlook, right? I care about where the market's going to go over the longer term, because the way I think about it is that my writings and my publications are sort of my short-term business impacts, and then my long-term investments are how I really sort of think about where I want to invest, because the market's doing well and I'm getting calls right, my business is going to grow. And if the market's not growing, if I'm not doing well and I'm not making the right calls, my business is going to shrink. And so I have like so much risk there that, when I try to think about where the market's going, I try to take that longer term viewpoint, because I'm trying to think about how I should position my portfolio for that longer term view. And, and so I think that the market right now, right here in November, you saw a tremendous amount of credits of easing. I mean, that's what this whole thing is.
Mm-hmm.
And that's risk, right? That's just the PE multiple expanding. It's not because earnings are actually getting better. I mean, I can show you that earnings estimates for 2024, and I said this on TV the other day. The girl who went on before me is talking about earnings are so great and they're so wonderful. But when you look at actual earnings estimates for this calendar year, they've been the same since December of 2022. They're actually a little bit worse, right?
Mm-hmm.
And so I understand that they're better than where they were last year, but don't you think that the market was already looking forward to those earnings last year, this year? For this year, last year, right?
Yeah.
And then the question becomes, will margins actually hold up? Because if these surveys are right and labor costs are still increasing, like this report just showed us, and if inflation is sticky in this 3.5% range, how are margins going to expand? I mean, right now we're looking for 11.8% margins in the S&P 500 this year. That's the high was in 2021 at 12.8. And you can see that margins in the fourth quarter came down drastically, in the first quarter came down drastically. My guess is they're going to come down drastically in the second quarter. And at some point, these numbers are going to come from 11.8 and probably be somewhere closer to 10. Because historically, margins, you can see I have going back to 2019, generally start high.
Yeah.
And then they fall. You know,
Right.
you can see, I mean, 2020, obviously the exception because of what happened.
Yeah.
But then you had 2021 where we had massive amounts of inflation getting pushed through the economy. Even in 2022, with all that inflation, margins fell off a cliff. They fell off a cliff in 2023, and I can't see how they're not going to do the same in 24. So if you have no sales growth, right, which is what basically is estimated, right, because again, inflation's coming down. So if inflation's coming down, your nominal growth rate is shrinking. You can see.
Yeah.
So
your margin compression.
Your margin.
I have one question because we're like coming to the end of
I know it
this
goes
time
so quickly.
And I have interrupted you less than anyone I've ever interviewed before because you're putting out some good stuff. But here's a key actionable question that I've been struggling with. Everyone, even real sharp people, are saying, the market's probably okay, the economy's probably okay until the fall. You have amateurs saying, well, I'm going to get out of stocks before the election and get back in after the election. It can't be that bad. Isn't the market set up for a nice, hard, sharp correction? And I'm talking 3,500. You talked 41. If it got 44, I think.
Yeah.
If it landed, so things could stretch the other way before the election, and then rally into the election. That everyone who thought things were going to be okay until November get a wake-up call well before they planned to get out because they see danger with the electoral process.
That's typically what's happened, though, Dale. I mean, think back to 2000, right? That was an election year and the market had a complete meltdown, right? Think back to 2008. That was an election year and the market completely melted. Think about 2012. That was
before the election or after the election?
In which year? 2012?
Well, I'm saying everyone thinks things are okay till November. Do you?
No, absolutely not.
All right. And if they can get out, they could wait until October to get out and get out great. And then the election.
But that's going to be too late.
Yeah, it's okay. That's what I wanted to hear.
This is look at 2012.
Yeah.
Oh, this is 11. I'm sorry.
Yeah. Okay.
Where's 12?
So it happened in July.
So this is
March.
This is September. We went down 8% into the election, starting in September.
Okay. I mean,
here we went down 11%, and that started in April, and that went into June. So there's certainly that possibility of something happening in that August to September timeframe. It happened right here.
Yeah.
Think about 2016, another election year. Look at all this volatility we had that year.
Oh yeah, and it went down into it. It was limit down.
Right. And then look at Brexit. Well, I mean, this was not. I mean, did we have a major, correction?
Crash?
That was a lot of volatility.
Yeah.
Obviously, I don't have to tell you what happened in 2020. No. So, people like to say like all the time, oh, it's an election year. The market's only going to go up because Biden's going to make sure it only goes up.
Oh, yeah. I'm hearing that too.
Yeah. I mean, but okay. Then
you also hear Paul's a Democrat. You hear that when he's not.
No, he's not. I mean, does he probably want Trump to win? Probably not. Yeah. But does he agree with probably the spending habit of government? Probably not.
Right.
But I hear all the time, it's an election year. market won't go down. Well, then I would say, okay, well, it's an election year. Do you think you're going to get bad employment data this year?
Yeah.
You think
Right.
that Biden's going to want to talk about a 4.5% unemployment rate and a negative 200,000 job print?
Yeah.
No.
My best guess for a high is right around option expiration this month into July for a high.
It could be. I mean, it could be, when the market realizes, hey, Fed's not going to give us any cuts this year, next week. What if next week's CPI, I mean, they're looking for a 0.1. Yeah. I haven't gone out and publicly written, I want to see this actually print a 0.1.
Michael, it's great having you back. And
okay. Sorry about yesterday.
Oh, and it's everyone is thanking you for your work, and there have been comments about your analytical tools and how you really have stood your ground when it hasn't been easy to, when price action is contradictory to what you're seeing under the surface. So I know what kind of year you've gone through with this kind of mania. But you know what? The cream always rises to the top. Don't forget that, Michael Kramer. And
thank you.
I always root for you, my trading warrior brother.
Thank you, Dale. Thanks for having me. And I apologize for yesterday.
No problem. So you want people to follow you, right? And check your
of course
out.
You can check out my Twitter handle with Dale knows. That's Michael Mott CM. I have a YouTube channel now where I put out almost a YouTube video. I wouldn't say it's every day, but probably about 4 days a week. I put out a YouTube video, so you can follow me there at the Market Chronicles. Nice. I have a Substack, which is also under the web address is themarketchronicles.com. And then I have my own website, which is Mod Capital Management. And then I write on Seeking Alpha under Mod Capital Management, and I put out a subscription service there called Reading the Markets.
Okay, that's great, Mike. And here I have a suggestion for you, that on your YouTube channel, we do a deep dive into currencies and precious metals one day.
We can do a live one. I've been wanting to do a live YouTube session for a while. So
okay, let me know. And have a great weekend, Mike. And I think you're going to be validated before the election. So
thank you.
I've taken I've gotten kicked in the teeth a few times in my
everyone does. If you've done this long enough, everyone gets kicked in the teeth.
You cannot get into a boxing ring without expecting to take a hit.
That's right.
So
you gotta be in the corner, though.
Yeah, definitely keep your hands up, my brother. All right, man.
Thank you.
All right, Michael Kramer, everyone. Find him, read him, integrate him into your intelligence gathering. This guy does a lot of hard work and is pretty giving about what he shares outside a paywall.
That's right.
Yeah. So listen, everyone have a great weekend. Hope we added value to what you're trying to accomplish. It's not easy. There's no secret to it. It's hard work and living through adversity. And if that scares you, do something else. And don't just count your pips, count your blessings. Adios, everyone. Thank you, Laura. Tom's thanking you. Mike, a lot of people appreciated what you brought to the table today. Adios, everyone. See you Monday. You could join the team in 10 minutes.